Today, higher for longer is the watchword as confusion reigns. Hello again, it's Miles North from Digital Finance Analytics World Notice Post covering finance and property news. This is our weekly market update where we start in the US, cross to Europe and Asia, and end in Australia, covering commodities and crypto on the way. It's the digest I use to help me understand what's happening, and I hope it'll help you too, despite the fact that this show actually takes longer to make than my other shows. It tends to get lower views, but it's the critical underpinning of all my work, so it's really important. And be warned, we do cover a lot of ground. This was another complex week, with waves of news, directives, trade issues, and economic data causing ripples across the market, against the backcloth of reinvigorated inflation fears and questions of whether central bankers are really as smart as they like to think. The global MSCI index was pretty flat across the week, but down 0.67% on Friday, while the European STOXX 600 rose 0.59% across the week, having closed at a record high on Thursday, helped by mostly robust company earnings, but also falling a bit on Friday. US equities closed broadly lower after the economy added fewer new jobs last month than expected, and a survey found consumers increasingly worried about rising prices, bolstering the case for the Federal Reserve to hold rates steady for longer. US jobs growth slowed more than expected in January, likely restrained by the wildfires in California and cold weather across much of the country, but it was a 4.0% unemployment rate, and that would give the Federal Reserve cover to hold off cutting interest rates at least until June. Non-farm payrolls increased by 143,000 jobs last month, after rising by an upwardly revised 307,000 in December. The report has likely taken a March rate cut off the table, said Principal Asset Management's Seema Shah. The moderation in jobs gains was also payback after December's robust performance. Economists had expected the establishment survey to show around 170,000 jobs added. The monthly University of Michigan Consumer Sentiment Index dropped to 67.8 from 71.1. That's well below the consensus. Consumers' median one-year ahead inflation expectations surged to a 50-month high of 4.3% from 3.3%. In addition to data prints, President Donald Trump on Friday said he plans to announce reciprocal tariffs on many countries early next week, heightening uncertainty for corporate America, still reeling from Trump's aggressive trade approach towards key allies Canada and Mexico. Trump, of course, has long championed the idea of reciprocal tariffs as a way to secure what he calls a fair deal for the US. He's repeatedly criticized the foreign levies on US exports and has threatened to target key sectors including imported steel, pharmaceuticals, and oil. Trump and his top aides suggested that the revenue from these tariffs could help offset the costs of extending his 2017 tax cuts, though tariffs have historically contributed only around 2% of annual US government revenues. We think a casualty of the president's unprecedented approach to trade policy is that Fed easing is over for now, and that means higher for longer Treasury yields than previously expected, Capital Economics said. Federal Reserve Governor Adriana Kugler said, given that inflation remains elevated, it made sense to hold rates at current levels for some time, and she also said there is considerable uncertainty about the economic effects of proposed new policies. Too right. The yield on the US 10-year note rose to 4.494%, while the 2-year was at 4.291. A quarter percentage rate cut by the Fed is still priced in for July, with markets expecting a total of 46 basis points of reductions by December. It's interesting that US Treasury Secretary Scott Bessent said on Wednesday that while Trump wants low interest rates, he will not ask the Fed to cut rates. He said that when Trump speaks of wanting lower rates, he's referring to the yield on the 10-year Treasury note. That's key to determining borrowing rates in the US mortgage market and bank lending to businesses, rather than the short-term rates set by the central bank, which is a nice spin there. At the close in New York, the Dow Jones Industrial Average fell 0.99%, the S&P 500 index closed 0.95%, and the Nasdaq Composite fell 1.36%. The Russell Small Caps was also down. Nasdaq's slide reflected a 4.1% drop in Amazon after disappointing quarterly results. Apple was 2.4% lower. In fact, all 11 of the S&P 500 industry sectors settled lower, driven down by consumer discretionary stocks. Tesla lost 3.4%. It's tumbled about 11% this week, dragged down by shockingly bad sales reports from around the world. The stock has fallen 25% from its December 17th record high. Uber surged 6.6% after billionaire Bill Ackman said his hedge fund owned 30.3 million shares of the ride-share company, valued at roughly $2 billion. We believe that Uber is one of the best managed and highest quality businesses in the world, he wrote in a post on X. Remarkably, it can still be purchased at a massive discount to its intrinsic value. This favourable combination of attributes is extremely rare, particularly for a large cap company. The VIX Fear Index was up 6.71% on Friday to 1654. The dollar initially surged against the Mexican peso and the Canadian dollar, but only reversed course on news of the tariff delays. The reaction to the Chinese yuan was more complicated by the fact that mainland markets were closed at the time of the announcement. In the process, the DXY index, which measures the dollar against the most traded currencies, managed a 2% round trip from last Friday's low, only to reverse by the middle of the week, with investors beginning to entertain prospects that a global trade war could be averted or not, based on what happened on Friday. The dollar index hit a 2-year high of 110.17 on January the 13th, but has since retreated. The irony is that the global economy's adjustments to a threatened trade war is undoing some of the intent of Trump's tariffs even before they go into effect, to the benefit of foreign companies that sell to US customers. If any of those import taxes do hit, the market's reaction function will be to lift the dollar, as concerns about the potential for overseas economic damage and domestic US inflation irritation exaggerate the relative interest rate gaps. That is a plus for many foreign firms because a stronger dollar can allow them to keep the dollar price of their goods stable in US markets, helping them to retain market share without a lockstep hit in their home currency earnings. But of course, a weaker local currency can affect both the country's employment and economic activity in complex ways. But overall, the currency market can offer an instant and significant offset to rising tariffs. The prime example is the weakening of China's yuan during Trump's 2018-19 bilateral tariff war, which clearly softened the fallout. The 20-nation Eurozone, a key target of Trump's rhetoric because of its large trade surplus, could also offset some of the punitive change via a currency that has weakened by around 7% since early autumn. The ECB, the Bank of England and the Bank of Canada have all cut interest rates in recent days, even after the Fed said that it was not in a hurry to move. And the Reserve Bank of India and the Bank of Mexico, though coming from higher levels, have also cut rates recently. The British pound versus the US dollar was at 1.2401, having fallen sharply after the Bank of England cut their interest rates as expected, but they forecast higher inflation and weaker growth, with two officials calling for an even larger rate cut. The euro US dollar was down 0.52% to 1.0327, while the US dollar Japanese yen rose just a little to 151.42. The yen touched an 8-week high versus the dollar on Thursday after a Bank of Japan policy board member advocated continued interest rate hikes. Gold futures for April delivery were up 0.4% to 2,887.60 a troy ounce, so gold remains on the up and as a safe haven, and possibly being impacted by physical gold being shipped to the US for fear of future tariff risks. But interestingly, gold miners are not feeling the love, with the gold miners ETF, the GDX, still below the levels seen back in 2013. The gold miners' stock prices have largely been decoupled from their metal, which overwhelmingly drives their profits. This fundamental disconnect has spawned a shocking valuation anomaly, with gold stocks far too low relative to gold, at least for now. But that is worth watching. Will miners' stocks soar to reflect their record earnings? We will see. Elsewhere in commodities trading, oil headed for a third weekly decline, as worries that President Donald Trump's tariffs on China would sap demand outweigh the new US administration's first round of sanctions against Iran. That said, crude oil for delivery in March did rise 0.57% on Friday to hit $71 a barrel, while the April Brent contract rose 0.48% to trade at $74.69 a barrel on Friday. But more broadly, prices have been hurt by the renewed trade war between China and the US and the potential for tariff hikes from the Trump administration on other countries. Just before we go on to look at Europe, I want to suggest that central bankers are wedded to the frankly inane Phillips curve theory, which believes inflation comes from too many people working. Inflation is not caused by prosperity or high rates of employment. It is even about supply shocks. They are a symptom of inflation. Inflation is a result of markets losing confidence in a fiat currency's purchasing power due to the profligate actions of a government and a central bank. The Fed creates high-powered money, credit, and reserves through fiat. This money is used to buy banks' assets such as treasuries, mortgage-backed securities, and sometimes even corporate bonds. The banks then take this credit to buy more of the same, sending the prices of assets much higher as those rates fall. Artificially low interest rates lead to capital misallocation, rising real estate and equity prices. Therefore, programs such as QE and ZIRP leads to asset price inflation and bubbles. The expansion of bank credit can lead to a broad-based increase in the money supply if the increase in bank reserves also leads to an increase in bank lending. When governments run huge budget deficits, banks tend to use those reserves to monetize government spending, leading to an increase in the broad-based monetary aggregates. Since the government is a very inefficient distributor of capital, the new money creation goes towards consumption rather than capital investment. This exacerbates the supply-demand imbalance, and CPI runs rampant. This was the case in the post-COVID era of helicopter money. Governments sent out checks, and they were monetized by private banks using the reserves printed by central banks. Much of this money was used to pay people not to work, resulting in the classic definition of inflation: too much money chasing too few goods. If you don't understand these fundamental concepts, you should probably not be managing money or indeed sitting at the head of a central bank. But for now, inflation has destroyed the purchasing power of ordinary people. Inflation is causing rates to rise, and rising interest rates are the predominant problem facing markets in early 2025. So I say, watch the credit impulse and the money supply. There is your true problem, central bankers, please note. European stocks closed lower on Friday following the keenly awaited US payroll data. The DAX index in Germany fell 0.6%, the CAC 40 in France declined 0.24%, and the FTSE in London fell 0.3%, having previously hit a new high. European stocks have staged their best performance in a decade against Wall Street in the first 6 weeks of 2025, but doubts remain on whether those gains can be sustained given the weakness of the Eurozone economy. German industrial production fell more than expected in December, according to data released earlier on Friday, decreasing by 2.4% compared with the previous month, and weaker than the 0.6% fall expected. Danske Bank stocks, though, rose 7.8% after the Danish lender reported solid financial results for the fourth quarter of 2024, supported by strong growth in core banking income, disciplined cost management, and credit quality. Saab stocks, though, fell 1% after the Swedish defence equipment maker updated its medium-term targets for the years 23 to 27. Legal & General stock initially surged more than 7% on Friday in London, but finished the day up just 1.2% after the British life insurer said it would sell its US protection business to a Japanese company. Henkel stock rose 1.3% after the German consumer goods maker agreed it would sell its retailer brand business in North America to an affiliate of First Quality Enterprises for an undisclosed amount. The UK stock market has been riding high of late, but Capital Economics expects the country's equities to underperform non-US global equities over 2025. The UK economy looks to have lost all momentum in late 2024, and the early signs this year suggest that things may actually be taking a turn for the worse. Additionally, the UK stock market doesn't appear to be well placed to benefit from enthusiasm over AI, which is expected to grow. The estimate for the European Central Bank's so-called neutral rate probably stands at between 1.75 and 2.25%. That's according to a paper from economists at the ECB. The prediction would suggest a potential stopping point for the recent series of ECB interest rate reductions that have left borrowing costs in the Eurozone at around 2.75%. Analysts broadly expect rates to settle at the around 2% midpoint of that range. Should that be the case, it could translate into potentially 3 more 25 basis point reductions of the key deposit rate by the ECB officials before the figure is a level that, in theory, neither helps nor hinders economic activity. But as Powell always says, you can only know this by its works. However, the economists warn against relying too much on those projections, saying that the numbers cannot be seen as a mechanical gauge of approximate monetary policy at any point in time. Last month, the ECB slashed rates by 25 basis points in a bid to address flagging economic growth in the Eurozone, though policymakers declined to commit to a specific path ahead for borrowing costs. Despite noting that the disinflation process is well on track and the impact from an era of restrictive monetary policy is gradually fading, the ECB said in a statement that the Eurozone's economy is still facing headwinds. And meanwhile, speaking at a press conference at the time, ECB President Christine Lagarde said frictions in global trade could make the outlook for Eurozone inflation more uncertain. US President Donald Trump, of course, has threatened to slap tariffs on the European Union in response to a perceived imbalance in trade relations and has already imposed a sweeping 10% levy on China. Most Asian stocks fell on Friday, but Chinese shares extended gains on AI optimism despite US tariffs, while the Reserve Bank of India reduced its interest rate for the first time in nearly 5 years. The RBI announced a 25 basis point reduction in the repo rate, bringing it down to 6.25%. This marks the first rate cut in nearly 5 years, aimed at stimulating the nation's slowing economy. The move came in the first policy decision under the new RBI governor, Sanjay Mehrotra. He highlighted that the combination of subdued economic growth and easing inflation provided the necessary space for this monetary easing. India's Nifty 50 was largely unchanged after the decision, ticking just down a little as the move was already well priced in. Despite the imposition of 10% tariffs by Donald Trump on Chinese goods, China's AI sector, led by companies like DeepSeek, have demonstrated resilience, bolstering investor confidence. China's Shanghai Composite rose 0.8% on Friday, while the Shanghai Shenzhen CSI 300 index jumped 1%, and Hong Kong's Hang Seng Index advanced 0.9%, and Hong Kong's listed Lenovo Group jumped 7.5%, while Xiaomi rose 4.8%. Elsewhere, most regional stocks were lower amid global uncertainty around those policies, keeping investors away from riskier assets. Japan's Nikkei 225 lost 0.5%, while the Topix fell 0.4%, and South Korea's Kospi was 0.3% weaker. Australian shares fell short of closing at a record high on Friday as traders awaited the US jobs data. The ASX 200 closed just 0.1% lower at 8,511 on Friday in a volatile session. The index slipped 0.2% this week, but came just 21 points away from hitting a new peak. The Australian dollar rose 2.2% this week to 62.84 US cents, following a wild swing. Against the British pound, the Aussie was at 50.59 British pence. 5 of 11 sectors were lower, with energy stocks falling the most. The index opened lower before turning positive, then turned negative again in thin trading as investors awaited that jobs report. Banks retreated, then paired losses, and CBA reset a new closing record. The stock actually closed up less than 0.1% to $162.67, and NAB gained 0.8%. Macquarie was at $229.97, well off recent highs. Energy stocks detracted, tracking a steep fall in oil prices overnight on Thursday. Beach Energy posted the largest loss on the ASX, down 5.2% to $1.37. A fall in coal prices overnight dealt a blow to Australia's coal miners too. Yancoal was 3.8% lower. Whitehaven Coal dropped 3.9% to $5.98. And the ICE Newcastle Coal Futures contract tumbled 7.1% this week to $109 a tonne. Meanwhile, reports that Chinese electric vehicle battery maker CATL has restarted its lepidolite mine hit miners on Friday. Liontown Resources sank 4.8% to 66 cents, while Pilbara Minerals dropped 4.3 cents to $2.23, and Patriot Battery Metals fell 5.9% to 32 cents. In corporate news, Domino's Pizza shares leapt 21.3% to $35.93 after the company announced the closure of 205 loss-making stores. Nick Scali's shares rocketed 10.5% to $18 after the company posted net profit of $36 million for the half year to December, exceeding guidance. Sigma Healthcare rose 3.2% to $2.92 after it upgraded full-year guidance for earnings before interest and tax, pointing to a boost from its Chemist Warehouse supply contract to business performance. The merger of the two companies is taking place this month. REA Group shares rose 2.8% to $262.12, extending a two-day rally on Friday after Morgan Stanley reiterated its overweight rating following a strong set of results that saw revenue jump 20% year on year. And a wave of profit-taking hit News Corp on Friday following its rally in the prior session, even as Morgan Stanley reiterated an overweight on the stock. The shares fell 3.8% to $54.14. Investment strategists have warned that certain pockets of the Australian share market are still vulnerable to simmering trade tensions, despite Australian exports not being directly targeted by US President Donald Trump, at least so far. That's due to the indirect consequences of higher China tariffs on the heavyweight materials sector that earns almost half its revenue in China through iron ore exports from the big miners like BHP, Rio Tinto, and Fortescue. If Trump's tariffs put further pressure on China's slowing economy, a real possibility in the absence of another round of stimulus from Chinese authorities, this could weigh on iron ore demand, said Morningstar market strategist Lachlan Holloway. China accounts for the majority of global iron ore demand through its property sector, a risk that has been priced into the Australian share market. The materials sector has been one of the biggest laggards since Trump was elected in early November. That is despite iron ore prices holding up remarkably well. Futures traded in Singapore jumped up further to $106.10 a ton on Friday. The surprising resilience caused iron ore bear Goldman Sachs to lift its average first half price forecast on Friday to $100 a ton. The broker had expected Trump to initially place a 20% tariff on China, double the 10% levy that took effect on Tuesday. Finally, in crypto, Bitcoin demonstrated a 2.2% surge after the January non-farm payrolls report was released and managed to jump over the 100,000 US level again just briefly. But then Bitcoin declined a little and is now trading lower than that psychologically important level, changing hands at 96,260. And that is archetypal, actually. It's showing you that wherever you look, uncertainty rules. And with so many things still in play, we can expect more volatility and uncertainty ahead. I don't think that the tariff story is over yet at all. And more broadly, I think markets are going to find the next 3 to 6 months very complicated to navigate. But the bottom line is this: higher for longer is the watchword. Rates will be higher. And that's going to put an interesting pressure on the RBA when they meet shortly. Because, of course, everybody is baying for a rate cut locally, but against the international backcloth, it may not come. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.